According to a recent analysis, on a standard $400,000 mortgage, the difference between a good credit score and an excellent credit score can cost you over $100,000 in extra interest payments over the life of the loan. Same house, same bank, same term. $100,000. This is not a fee. It is a tax you pay for not understanding the system. Your credit score is not just a number. It is one of the most expensive or profitable pieces of knowledge you will ever possess. This number is shrouded in myth and complexity, but it is governed by a simple, transparent formula. In the next 10 minutes, we will demystify this system entirely. You will learn the 5 components that make up your credit score, how to diagnose and fix your own, and discover how the financially sophisticated leverage excellent credit, not just to save money, but as a powerful tool for building wealth. First, what is a credit score? It is not a measure of your income, your net worth, or your character. It is a 3-digit number, typically ranging from 300 to 850, that serves one purpose: to predict the statistical likelihood that you will fail to pay back a loan in the next 90 days. It is a risk assessment for lenders. A high score means you are a low risk. A low score means you are a high risk. This single number functions as your financial passport. It determines not only if you can get loans, but more importantly, at what price. It dictates your mortgage rates, the interest on your car loan, the APR on your credit cards. But its influence doesn't stop there. Increasingly, your credit is checked by landlords before they rent to you, by insurance companies when they set your premiums, and even by some employers during background checks. It is the central gear in your financial life. So, who calculates this number, and what exactly are they measuring? The entire system is built on a precise formula with 5 components, and the 2 most important ones make up 65% of your entire score. Do you know what they are? The most widely used credit score is the FICO score. It is not magic, it is a weighted algorithm. Let's break down the recipe. A pie chart graphic of the FICO score components appears on screen. Theory: the FICO score ingredients. Payment history, 35%. This is the king. Do you pay your bills on time? One single late payment can have a significant and lasting negative impact. This is the single most important factor. Amounts owed, 30%. This is primarily measured by your credit utilization ratio. This is the amount of revolving credit you are using divided by your total credit limit. A ratio below 30% is considered good. Below 10% is excellent. Length of credit history, 15%. This is the average age of all your credit accounts. A longer credit history provides more data, making you a more predictable borrower. Older is better. New credit, 10%. This looks at how many new credit accounts you've recently opened or applied for. A flurry of new applications can signal financial distress and is seen as risky. Credit mix, 10%. Lenders like to see that you can responsibly manage different types of credit, such as revolving debt, credit cards, and installment debt, mortgages, auto loans. Analogy: your financial trust score. Think of your credit score not as a grade, but as a trust score that you are constantly broadcasting to the financial world. Payment history, 35%, is your reliability. Do you keep your promises? Amounts owed, 30%, is your responsibility. Are you overextended, or do you live within your means? Length of history, or 15%, is your experience. Do you have a long, proven track record of trustworthiness? New credit and credit mix, 20%, are your judgment. Are you disciplined and thoughtful in how you manage different types of financial tools? Example: the credit score. Turnaround. Let's say a person has a 640 score. How do they fix it? They focus on the big levers. Attack payment history, 35%. They immediately set up automatic payments for every single bill. Late payments become a thing of the past. This is non-negotiable. Crush utilization, 30%. They have a credit card with a $10,000 limit and a $6,000 balance, 60% utilization. Their top priority is to pay this balance down. Getting it below $3,000, 30%, will provide a significant boost. Getting it below $1,000, 10%, will supercharge their score. Mastering these two factors, paying on time and keeping balances low, will solve 65% of all credit score problems. This is the foundation of any sound wealth management plan. The rules are simple, yet people consistently fall for two destructive myths. Pitfall number 1, closing your oldest credit card. A common mistake. You have a card from college that you never use, so you close it to be responsible. You've just damaged your score in two ways. You've reduced your total available credit, which can increase your utilization ratio, and you've shortened the average age of your credit history. Keep old, no annual fee accounts open forever. Pitfall number 2, carrying a balance to build credit. This is a pervasive and expensive myth. You do not need to carry a balance and pay interest to build a good credit score. Using a credit card each month and paying the statement balance in full before the due date is the optimal strategy. It demonstrates responsible usage without costing you a single cent in interest. Avoiding these myths is the first step to mastering your credit. But once you've built an excellent score, how do the wealthy use it not just to save money, but to actively make money? The advanced strategy, credit arbitrage. Once your credit score is in the excellent tier, typically 760 and above, you are no longer just a borrower. You are a highly sought-after customer. You gain access to the most lucrative financial products on the market, particularly 0% APR introductory offer on credit cards. This unlocks a strategy called credit arbitrage. The theory: arbitrage is the practice of simultaneously buying and selling an asset to profit from a difference in price. With credit, you are profiting from the difference in interest rates. The execution. A financially disciplined individual with an excellent credit score might be planning a large, necessary purchase for $10, e.g., new appliances. They have the cash to pay for it. Instead of using their cash, they apply for a new credit card with a 0% APR on purchases for 18 months. They put the $10,000 purchase on the new card, costing them 0% in interest. They take the $10,000 in cash that they would have spent and place it into a high-yield savings account or short-term treasury bills, earning, for example, 4.5% interest. For 18 months, they are earning 4.5% on money they have effectively borrowed for free. Before the promotional period ends, they use the cash and the interest earned to pay off the credit card balance in full. This is a sophisticated strategy. It requires extreme discipline. If you fail to pay off the balance before the 0% period expires, the retroactive high interest rates will wipe out any gains and then some. But for those who have mastered their financial habits, it's a powerful way to turn an excellent credit score from a defensive tool into an offensive one. Let's distill this into the 3 core truths about your credit score. It is your financial passport. Your credit score is a trust score that dictates your access to capital and the price you pay for it. It is a tax on the undisciplined and a subsidy for the diligent. Master the big 2. Your score is a formula. To control the output, control the largest inputs. Master payment history, 35%, and credit utilization, 30%. And you will have solved 65% of the puzzle. Pay on time. Keep balances low. Leverage is the final step. Once you have built an excellent score, you can transition from defense to offense. You can leverage premier financial products to create opportunities like credit arbitrage, turning your good habits into tangible income. Your credit score is not a reflection of your past. It is a tool for building your future. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.